Not too long ago, we ran through Nancy Pelosi's latest buys and sells from just a few weeks ago, but today we want to take a look at Vistra Corporation. Now, this is one that she actually purchased call options, and we can see the amount is around $500,000 to the $1 million mark. And whilst the price is down around 1% since that point, one of the reasons why we do closely look at her buys as well as her sells, because she typically tends to massively outperform the S&P. If we just look at the last 10 years, she is up 785%. The S&P in comparison up only 222. Now we're actually going to take a look at this company in detail because it has come up again. When we've seen the release just yesterday of David Tepper, the billionaire, we can see that the number one buy of his portfolio from the latest quarter is VST, where he added around 1.5 million shares. And whilst you may think that is insignificant given the change is only around 3% to his overall portfolio, this is now his fifth largest position and compromises around 6%. So we want to understand, what is this company, why are billionaires as well as Nancy Pelosi loading into the company, and whether we should consider adding ourselves. Now, Vistra Corporation is a Texas-based energy company that generates, sells and delivers electricity to residential, commercial and industrial customers, and they operate a diverse portfolio of power plants including natural gas, coal, nuclear and renewable energy sources. Now we just want to highlight from their latest investor presentation that the financials do look very strong. Just over the last 3 years we can see the upward movement, but there's growth in both the generation, which takes up the bulk of their top line, as well as their revenue. We also like the fact that moving forwards they are guiding for an increase to the EBITDA, and on top of that they expect free cash flow growth to continue. One other point that is very important is when companies look at their capital allocation, and with Vistra Corp they like to return excess cash to investor pockets. As we can see, the shares outstanding has been decreasing by quite an aggressive rate, and that is just over the last 3 years, whilst the dividend per share has been increasing. Now if we look at the company itself, it is up around 293% over the last 12 months. Over the last 5 years, up 656, so on both accounts has massively outperformed the S&P 500, and right now it does trade at the upper end of the 52-week range. Both Seeking Alpha and Wall Street do consider this company to be a buy, and it does pay a dividend, although on the trivial end at 0.53%. If we were to take a look at their earnings over the last 3 quarters, they have outperformed 2 of them, notably a very large beat in Q2. Over the next 3 quarters, they're also expecting massive growth, 2 of them triple-digit growth, with Q2 looking at 47%, and based on the earnings per share for 2025, the forward PE currently sits at 21.49. Now how does this compare? Well, the sector comparative does sit quite some way lower at 17.55, as well as the 5-year average at around 16.3, so we do understand why we get a valuation grade of an F. And if you do look at the majority of valuation metrics here, this is pointing out to us that the company does trade at a premium. Doesn't mean we shouldn't consider it. We want to see how does it perform in growth and profitability, and straight away they get an A- on the growth spectrum. Year on year up 4.5%, a lot better than the sector that is negative 1.5, however marginally lower than their 5-year at 6.5. Moving forwards though, they expect 13% growth, which is well above the sector comparative of 2.2, as well as above their 5-year. And we also like the fact that the EBITDA growth is looking very strong, both on a year-on-year comparative as well as forward-looking, 34%, 25%, and the respective comparatives for the sector at 7 and 8. Profitability also looking very strong at the A rating. Gross margin 42%, a little bit lower than the sector, but very key to point out here, they have been improving their efficiencies, as over the last 5 years, on average, it's sat at 28%. In terms of the bottom line net income, 12.5%, pretty much in line with the sector, but significantly better than their own comparative, which was below 1%. And if we do look at the cash generated from operations, very high, 4.09 billion, a lot higher than the comparative for the sector at 1.3 and above their own 5-year average of 2.48. On top of that, we also notice momentum with this company currently sitting at an A+. We do, however, want to point out that the institutional ownership does sit at 91%, and we have seen a lot of selling of this company, around 5.4 billion. This is just over the last 12 months, pretty much 2024, with actually less buying than selling at 4.81 billion. However, we will note that over the last 2 quarters, institutions were starting to reverse that and started to buy more than they were selling. When we take a look at insider ownership, well, that sits at 1.42%, and whilst we do get a little bit of insider buying, we actually got a lot more selling at 70.5 million. But in quarter one, pretty much in January, no movement. In Q4, we did get around 55 million worth of sales. Now we'll show you for full transparency, because as always, we don't believe this to be a bearish signal. Management sell for many reasons, personal and financial, and you can already see here Nancy's buy around the 14th of January, as we mentioned, around $500,000 to 1 million worth. And we can see in terms of the insider, you'd have to go back to around the 10th of December. The director, in fact, selling 20,000 shares and netted them $2.8 million. As always, information is here, but remember to always do your own due diligence. In terms of the quality of the company, a quick look at the underlying metrics. Now, dividend safety, borderline safe. We'll cover these two valuation metrics. Nice to see their last full dividend increase sitting at the 13% point. And for those that are interested, it was reaffirmed November last year that the borderline safe score should be attached, and this ultimately means there is a moderate risk of a dividend cut over a full economic cycle. Now, the key metric here from the 07-09 recession tells us that their recession sales of negative 32% was significantly below the S&P, which at that point was negative 12. As we've already mentioned, their last full dividend increase at 13%, and they have been paying a dividend which has been increasing over the last 4 years. Now, the first valuation model that we are looking at, remember, we're not looking at any in isolation, we'll get to our own conclusion, is based on the P comparative. Now, what you can see is the blue tunnel, which actually tells us the expected fair price, and there is massive disparity between where this company sits and the expected value. So this is what we would call a severe overvaluation signal, but remember, we're not looking at any model in pure isolation. We would typically use dividend yield theory, which would tell us a company is undervalued when the current yield sits above the 5-year. Given they've only been paying for the last 4 years, probably not reasonable, but what this points out, as we've already highlighted, currently their forward P does sit above the 5-year, 24 versus 10. That is an overvaluation signal, and we've already highlighted it does trade at a premium to the overall utility sector. In terms of looking at the first valuation metric, now we get to the free cash flow payout, where we want to see ideally below 60%. What we can see, a lot of inconsistency, although nice to note, 29% over the last 12 months, 10% over the next 12, so we should be able to expect a double-digit increase over the next full year. And in terms of free cash flow, a lot of inconsistency again year on year, although this is to be expected based on the cyclicality of the industry. And then we get to the sales growth, some years looking very strong, other years we do note negative, in fact 3 of the last 10, 8% over the last full year and 4% on a trailing 12 month. Remember, 3 to 7% is what we usually want to see, just at a bare minimum to keep up in line with inflation. Sales growth, we get to see nearly 3 times growth over the period, and one thing we can see based on the shares outstanding is some aggressive share buybacks, at least from 2018, going from 505 million down to 356, and remember, this is one-way companies return excess cash to shareholder pockets. ROIC 10% or more, we do get a lot more inconsistency, 14% in terms of the trailing 12 month, which is good, but sometimes we do want a bit of consistency, and then we can see the inconsistency shining through both the operating side as well as the free cash flow. This then brings us to the net debt to EBITDA, which we want to see below 3, and the numbers you see below, number of years it would take the company to pay off all of their debt net of cash on hand, 3.23 on a trailing 12 month, so no surprises why we got the borderline safe score. Over the next 12 months, expected to come down to around 2.46, which is a good sign, but probably something we do want to keep an eye on, as ultimately this correlates as well to the balance sheet strength. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab another spreadsheet of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation, where we get our intrinsic price at $197 derived from the DCF model. Now we'll show you we have the free cash flow year on year. Average growth is skewed as it has gone from negative to positive a few number of years. we've gone 4% moving forwards, as you can see, low, medium and high. Now remember, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for VST or any others. But based on the 4% and the 8% discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 197 indicating 19% upside. Now, given the free cash flows are a lot more volatile, we have gone for the lower rate today, but full transparency, we'll show you at the 6%, 234 indicating 41% upside, and at 8%, 277, 67%. Now, using the 4%, we aren't just done yet, as we always like to add a margin of safety. We use 10% at a bare minimum, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy at 177, and as we keep going to near the current trading price, we can see based on the value right now, you get a 15% MOS. Remember, that is 4% to the free cash flows moving forwards. Wall Street themselves see around 16% upside, their price target $192. As always though, give us your thoughts. Is this one you are looking to buy? Maybe the fact that Nancy Pelosi, now we've got the billionaire as well, has brought it to your attention. But as always, do your own due diligence, and don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Also come and join us in the Patreon, where we do cover our weekly buys and sells. We have been buying and selling over the last few weeks. And as always, have a great day. We'll see you all on the next one.